Economic Relations in the Center for Human Rights at the University of Pretoria. And it's my great pleasure to welcome you on behalf of the institution to the opening event of Debt Conference 2020. We're particularly delighted to be hosting this first event in what must be the first multinational, multi-week, multidisciplinary virtual conference about sovereign debt. I think it's particularly fitting that this first conference like this should be about sovereign debt, because sovereign debt, like the COVID-19 virus, is a very serious issue that affects all of us around the world and whose full impact is understood to be serious, but cannot be fully anticipated exactly how it will affect us. We're particularly honored to have the South African Reserve Bank Governor, Lesetja Kganyago, as the opening speaker for this event. And I know most of you want to get to hear him as quickly as possible. But before we do get to hear him, I wanted to invite the two people who are most responsible for putting this unusual conference together, Professors Anna Gilpin and Hugo Paneeza, to say a few words of welcome. Just before they start, one housekeeping rule. Can I ask you all please to keep your microphones on mute so we minimize the noise assigned, the background noise. And also, if you do have any questions, please put them in the chat box, and then they'll go to our host, and then we'll be able to respond to them at the appropriate time. So with that, let me hand you over to Anna.
Well, really, we would not want to keep you from hearing from Governor Kganyago, but the thing that I want to say most is thank you. Thank you to Danny for taking this leap. Thank you to all of our hosts around the world who really in a few weeks' time organized this unprecedented event. And thank you to Hugo, who decided to take this risk as well. And really, we just could not be more moved and proud at what has transpired so far. We could not have wished for a more exciting opening day. There is no better place to, I mean, we have wanted to have an event in Africa. We have wanted to have an Africa-centered event, and being able to open in Pretoria today is really just the most incredible gift we could wish for at this really difficult time for everyone. So good morning, good afternoon, good evening to everyone. We hope that you will join us throughout the 2 weeks in Europe, Latin America, Asia, and in Washington next week. And with just deep, deep gratitude, I pass it on to Hugo. Thank you.
Just quickly to join Anna in thanking everybody, in thanking Daniel and Professor Cooper for organizing the event from Pretoria, the governor, the deputy governor, and all our partners around the world. When we called, they answered enthusiastically. So we started with Pretoria, and then we got to Florence, and then to Buenos Aires, and then to Geneva, and then to Singapore, and then to Barbados, and London, and Beijing, and then Washington. Actually, Washington was before, but anyway, so I got the sequence wrong. But thanks to everybody. You know, Anna is the person who did the real work, Anna and her team. So thanks to Anna. Thanks us, we're organizing. We got a lot of emails from Jordan, who kept all of us online, and we managed to get things done. So again, thanks to everybody. And now I'll just go back to Daniel that can start the conference. Thanks, Daniel.
Thank you, Hugo and Anna. It's now my great pleasure to introduce Dean Elsaby Skuman, who's the Dean of our law faculty. She will introduce the Vice Chancellor, Professor Tawana Cooper, who will then introduce our keynote speaker, the Governor.
Good day, everybody.
Good to you, Elsaby.
Thank you, Danny. Good day, everybody. It's good morning, good afternoon, good evening, depending on where you are at this time. It's really a great honor for me to welcome you to this 4th annual Distributed Sovereign Debt Research and Management Conference, quite a mouthful. The University of Pretoria, and more specifically the Faculty of Law's International Development Law Unit, takes great pride in hosting this virtual conference with 9 other institutions around the world. As you know, this conference is an annual event that seeks to bring cutting-edge research on sovereign debt to bear on policy and market practices, and to make research more relevant through exposure to policy and market challenges around the world. The conference attracts a global audience from academia, international institutions, policymakers, civil society organizations, and industry. And this year, due to the global COVID pandemic, of course, this conference is being held online from today till the 18th of September. And I'm sure that it will attract even a larger audience because of the fact that it is virtual and online. One of the we will also appreciate that the COVID pandemic has exposed urgent new sovereign debt challenges and also exacerbated old ones. So this should be a very, very interesting conference. The opening session today is the only one specifically focused on Africa, with the remaining sessions to be held across the world, all of them virtually, but you know that we benefit from shared experiences. So in particular, I would like to welcome the Governor of the South African Reserve Bank, Governor Kganyago, and the Deputy Governor of the Bank of Ghana, Governor Aru Awatsi, to this session this afternoon. I would also like to welcome our Vice Chancellor of the University of Pretoria, Professor Kupe, and I would now like to ask him to introduce Governor Kganyago. Thank you. Please, Professor Kupe.
Thank you, Dean Skuman, first woman to become Dean of the Top Law Faculty in South Africa. And thank you to all of the organizers. It is now my great honor, ladies and gentlemen, to welcome the Governor of the South African Reserve Bank, Lesetja. Lesetja was appointed as the Governor of the South African Reserve Bank for a second term in November 2019. His first was effective from 9 November 2014. He had been a Deputy Governor of the South African Reserve Bank since May 2011. In this role, he was responsible for a wide range of areas, including research, financial stability, bank supervision, financial regulatory reform, including introducing the Twin Peaks regulatory structure, the ideal structure in this regard, financial surveillance, including taking responsibility for the regulation of cross-border flows, risk management and compliance, and the functions of the South African Reserve Bank Academy. Governor Kganyago has more than 20 years of experience in formulating and implementing public policy, having spent his time at the Central Bank and at National Treasury. During his time at the National Treasury, a fundamental reform in the management of the national debt portfolio was completed, and he successfully steered several public finance and financial market reforms. Governor Kganyago has led South Africa's technical team in various G20 Minister of Finance and Central Bank Governors meetings and summits, including the inaugural summit in 2008. He has chaired the IMF World Bank Development Committee and the G20 Working Group on IMF Governance Reform. He was also the Vice Chair of the Financial Stability Board Standing Committee on Standards Implementation for 4 years. Currently, Governor Kganyago chairs the Committee of Central Bank Governors of the Southern African Development Community, SADC, and co-chairs the Financial Stability Board's Regional Consultative Group for Sub-Saharan Africa. He also chairs the Financial Stability Board's Standing Committee on Standards Implementation. He was appointed as the International Monetary Fund and Financial Committee Chairman, effective from 18 January 2018 for a period of 3 years. The IMFC is the primary advisory body of the IMF Board of Governors and deliberates on the principal policy issues facing the IMF. Governor Kganyago holds a Master of Science degree in Development Economics from the University of London School of Oriental and African Studies, and a Bachelor of Commerce degree in Accounting and Economics from the University of South Africa. Ladies and gentlemen, Governor Kganyago, Governor, your audience today.
Thank you very much, Professor Kupe. And thank you very much to the Dean and to Danny for living up to what I said he must do when he left the South African Reserve Bank. I told him that once you work for me, you will always work for me. And here he is today. He has organized a conference for me. Good afternoon, good morning, ladies and gentlemen. All protocols observed. I would like to thank the International Development Law Unit, Center for Human Rights at the University of Pretoria, for inviting me to deliver this opening address at the 4th Annual Distributed Sovereign Debt Research and Management Conference, or DebtCon as it is called. DebtCon was launched in Georgetown in January 2016, and its mission is to engage scholars and practitioners across geographical, disciplinary, and institutional boundaries to help solve sovereign debt problems. I think this is a very opportune time to bring together the brightest minds to consider the African debt conundrum. I must say at the same time, I thought that as we meet here, this conference would have preferably been organized by the Economic History Department. That it is going to be a conference that tells us how we used to have debt and how we came out of that debt. Because it is not long ago that we campaigned quite vigorously for debt relief for highly indebted poor countries. And we thought that the countries were all out of the debt, and now, straight back, most of the countries that benefited from debt relief are once again showing debt stress. But before I proceed, I should remind you all that I am actually a central banker. I just happened to have been a debt manager in my younger years. So the experience since the global financial crisis suggests that when central banks are called upon to discuss sovereign debt issues, countries must be in trouble. Today, I'll be making some remarks on the sovereign debt situation from an African central bank perspective. And I would like to start by prefacing my remarks by highlighting that while debt has a very important role to play in economic development, one should also reflect on the challenges and pitfalls presented by debt to developing countries in sub-Saharan Africa. Experience has shown that unsustainable debt burdens and rising debt service costs crowd out spending in key development areas such as education, health, and infrastructure. These were exactly the lessons learned during the African debt crisis of the 80s and 90s, and which justified debt relief. Consequently, badly managed debt can potentially reverse some of the developmental progress made over the past 20 years. The key is how the funds are utilized and how the debt is managed. Now for some context. The advent of COVID-19 pandemic since the beginning of 2020 has underpinned a surge in sovereign indebtedness globally. The magnitude The pace and spread of the build-up in debt obligations have raised macroeconomic and financial stability concerns, especially for emerging and developing countries. Rising debt levels have increased the vulnerability of the global financial system to financial market stress. Since 2008, global debt has risen to 230% of GDP, and EMDE, that is the emerging market and developing economies debt, has risen to a historic high of 170% of GDP in 2019. In addition, more than 25% of corporate debt in emerging market economies is denominated in foreign currency. There is also renewed concern about the sustainability of rising debt levels on the continent. The World Bank, in a 2020 International Debt Statistics report, has designated Sub-Saharan Africa as the region with the fastest growing debt levels in the world, with the pace of increase raising concerns about debt sustainability on the continent. According to the International Monetary Fund, about 40% of countries on the continent are currently at stressed levels. At the global level, the COVID-19 pandemic has forced a strong fiscal response by many countries in an effort to avert lasting structural damage to the economy. However, the recessionary conditions coupled with the significant deterioration in the economic outlook in many countries have refocused our attention in the record-breaking debt matrix. Global debt, that is public and private, have increased to a record $253 trillion in the first quarter of 2020, with the public sector accounting for around 60% of these issuances. By way of comparison, global debt amounted to $291 trillion at the end of the fourth quarter of 2000. According to the old age adage of history serves as a mirror so that we can avoid past tragedies, such is the didactic character of debt oscillations. With each wave of debt comes a composite reflection of causes, consequences, and possible lessons for market participants and policymakers alike. A recent publication by the World Bank entitled "Global Waves of Debt, Causes and Consequences" is instructive in this regard. According to the World Bank, there had been 4 debt waves in the post-Bretton Woods period. The first wave was fueled by a low interest rate environment and a rapid growth in syndicated loans, which induced governments to accumulate high levels of debt during the 1970s and 1980s. This had negative implications for the health of the banking sector in lending countries, mainly the US, and culminated in a debt crisis, which was followed by a prolonged debt relief and debt restructuring episode. The second global debt wave emerged from between 1990 and early 2000s and occurred against a backdrop of financial liberalization and innovation that enabled banks and corporations in the East Asia and Pacific region and governments in Europe and Central Asia to borrow heavily in foreign currencies. Predictably, This debt wave also ended with a series of crises between 1997 and 2001, when a change in investor sentiment sparked a widespread sell-off. This was followed by a resumption of investor confidence, which set the stage for the third debt wave. The build-up of private sector borrowing lasted several years until it culminated with the global financial crisis in 2007 to 2009. Emerging from the global financial crisis, history was about to repeat itself. A new fourth wave of a debt cycle followed, which was marked with similarities to the previous oscillations. It was fueled by low global interest rates, a rise in regional banks, increased demand for local currency denominated bonds, and increased demand for emerging market and developing economies debt issued by an expanding non-bank financial sector. African countries have and continue to be active participants in the new debt wave. The average general government debt ratio for low-income sub-Saharan Africa countries has increased from 22% of GDP in 2010 to 43% in 2019. This is according to the IMF's Fiscal Monitor. But even before the shock of COVID-19, public debt ratios were on the rise in the region. However, the start of the COVID-19 pandemic, the global growth shock, a splash in commodity prices, reduced growth outcomes, and revenue collections will further exacerbate the increased sovereign indebtedness across the continent. Economic theory can assist in framing the conjunctural policy challenges and options to address high and rising levels of sovereign debt in Africa. First, the so-called debt overhang theory postulates that future growth could be in jeopardy when a country's debt service cost exceeds its ability to repay. In such cases, the absence of concessions by creditors exacerbates the fiscal constraint and adversely impacts the growth potential, especially for poor and emerging economies. Second, does the level of indebtedness matter for economic growth? Well, Reinhardt and Rogoff argued that growth rates decline significantly when public debt ratios exceed 90% of GDP. Interestingly, their work was styled, "This time it's different." Well, here we are now. This work was done in 2010. We are in 2020, and as it turns out, this time is not different. This assertion set in motion the threshold debate, with some critics pointing out that Reinhardt and Rogoff's findings were modestly inflated. But again, here we are, and this time is not different. And the threshold debate has been resuscitated. The IMF and later papers by Reinhardt and Rogoff have concluded that increased debt does indeed lower the level of economic growth, albeit with a somewhat lower impact than was stated in earlier studies. And Claessens points out that large external debt and its associated service obligations can affect economic performance through the crowding out effect. That is the impact on a country's ability to access international financial markets and its impact on confidence levels. It is worth pointing out that the crowding out effect also applies to local currency public debt, especially where banks end up recycling depositors' money into government bonds rather than on lending for productive investment purposes. And finally, it would be remiss of me not to highlight that it also presents risks to the implementation of monetary policy and poses a risk also to financial stability. A high level of public debt also raises the risk of fiscal dominance. This is where monetary policy is subordinated to keeping debt servicing burden manageable at the expense of price and financial stability. We are faced with a myriad of challenges that require a delicate balance between novel ideas and solutions and the prudence required for sustainability. Let's bring this back home. Try and elaborate on the most recent African experience with debt. At the turn of the 21st century, billions of dollars worth of debt was wiped clean across sub-Saharan Africa. South Africa was instrumental in pushing for debt relief and succeeded in late 1990s when the HIPC program was agreed through the Development Committee of the World Bank and the IMF. At the time, the solution appeared simple: wipe off the debt and allow countries space to get their affairs in order, and growth and stability will follow. For a time, significant improvements were observed with many countries strengthening their macroeconomic frameworks and institutions. A number of countries also gained market access. With the advent of the lower global interest rate, countries also had the opportunity to increase their debt issuance. By 2018, international bond issuance in the region reached a new high, totaling more than $17 billion, with the average issuance rising to nearly $3 billion. About 16 sub-Saharan African countries were at the high risk of debt distress, more than double the 2013 levels. Average public debt across the region rose close to 56% of GDP at the end of 2018, with wide disparities in debt dynamics across countries. For example, in 2018, public debt to GDP stood at 72% in Zambia and 100% in Mozambique. Debt servicing costs rose sharply, with the median interest payment burden doubling to about 10% of revenue between 2011 and 2018. By the end of 2019, economic growth in sub-Saharan Africa was seen to be improving from the low base of the early 1990s. Real GDP was projected to increase by 3.7% in 2020. However, this was still well below the averages of the 2000s. By the mid-2019, there was a growing number of voices raising concern about macroeconomic stability, given the widening of fiscal positions in a number of low-income developing countries. According to the IMF, debt burdens and vulnerabilities of these LIDs have risen significantly since 2013, reflecting a mix of factors, including exogenous shocks and loose fiscal policies. The continent's total external debt burden reached nearly $500 billion in 2019. But governments have been pressured into further borrowing to counter the effects of COVID-19 the COVID-19 pandemic. In part, this has been due to the low returns on most financial assets worldwide, triggering an appetite for frontier market assets. Debt levels have been increasing considerably during 2020, with the interplay between various factors, most notably the need to manage the impact of the COVID-19 pandemic. As mentioned earlier, the various international bodies have indicated that Sub-Saharan Africa is the region with the fastest growing debt burden in the world, with the pace of increase raising concerns about debt sustainability on the continent. Well, let me use the case of South Africa to reflect on some of the costs of rising debt. The National Treasury has pronounced on the trajectory for South African fiscal position in the 2020 budget review that the outlook is bleak, which would be the main source of weakness to the domestic sovereign bond market. Well-developed local currency bond markets have allowed governments to tap debt markets at potentially favorable terms to counter real economic costs. South Africa's local currency bond market, which has undergone significant growth since the late 1970s, is achieving its level of depth, liquidity, and sophistication, and has enjoyed these benefits. South Africa's sophisticated level of local currency bond market was made possible through a concerted effort by the National Treasury to implement a clear and prudent debt management strategy. The strategy entailed reducing borrowing costs and risks through increasing liquidity and managing maturity profiles, diversifying funding instruments, increasing transparency and information flows, and building credibility amongst market players. The National Treasury took specific actions to achieve this price and maturity benefit. One of the first steps was the consolidation of government bonds into benchmark bonds, as well as the development of the yield curve. There was also a deliberate focus on deepening the secondary market for government securities, where the SARB played an active role by acting as a market maker and funding agent in a number of benchmark government bonds. At its peak, SARB's participation in the secondary market accounted for an estimated 30% of total turnover. But by the late 1990s, the secondary market was judged to be sufficiently mature for the SARB to reduce its involvement and improve efficiency and transparency. When the global financial crisis hit our shores in 2008 and 2009, South Africa had been running small budget surpluses. The debt to GDP ratio was under 30%. This allowed for increased government spending, part of which was initially justified as counter-cyclical stimulus, but which was not subsequently reversed. Persistent fiscal deficits have since caused a dramatic increase in the debt to GDP ratio, which incidentally has been larger than that of emerging markets, except for Argentina. Some attempts were made at fiscal consolidation over the decade. However, this was underpinned primarily through tax increases, with aggregate spending kept growing, or at least failed to decline as a share of GDP. The main drivers were above inflation growth in the public sector wage bill, rising interest costs, and bailouts of state-owned enterprises. In short, the domestic fiscal position was highly challenging before the COVID-19 crisis, with the 2019-2020 fiscal deficit being 6.7% of GDP and the debt to GDP ratio of 63.5%. The COVID-19 shock is now projected to result in a budget deficit of 14.6% of GDP and increase the debt stock past 80% of GDP for the current fiscal year. As pointed out in the revised budget, there are significant risks of debt exceeding 100% of GDP in passive scenarios over the next few years unless government implements strong corrective measures to stabilize the debt by 2023/2024. South Africa has now lost its investment grade credit rating from all the major rating agencies. Government bond yields are unusually high, with inflation-adjusted yields in the region of 4 to 5%. With the steepening of the yield curve, the National Treasury has had to shorten the maturity of its debt to limit borrowing costs. However, this raises risks as redemptions are not spread out over as long a period as previously. In addition, capital inflows to South Africa have declined. With government deficit approximating the supply of private domestic savings, the implications for private investment spending are bleak, while real non-interest spending is budgeted to increase further this year, in large part to fund COVID-19 relief measures. South Africa needs a substantial fiscal adjustment complemented by strong structural reforms to minimize the impact on the medium-term growth. Let me conclude then with some implications for policy, which are associated with the current debt dynamics. What we are now faced with is that African countries are having elevated levels of debt. And with these elevated levels of debt, we have called for relief. President Ramaphosa has appointed a delegation of envoys who are going all over trying to deal with this challenge. But what we are currently facing on the continent is that interest payments constitute the highest item of government budget for many sub-Saharan African countries. Current estimates indicate that sub-Saharan Africa faces a $44 billion debt service bill in 2020. This is due to a combination of interest rate and exchange rate effects. African countries thus face high borrowing costs. For example, 10-year government bond yields range between 5 and 10% as compared to near zero or negative rates in some developed economies. The increased reliance on non-traditional creditors has raised borrowers' exposure to market risk, while at the same time posing additional challenges to the sustainability of external debt in the region. For instance, in the case where countries find themselves in debt distress, it may be more difficult to come to a rescheduling agreement with a large number of private creditors than when you had in the past a relatively small number of public creditors where you had the Paris Club or commercial bank lenders, the London Club. Challenges such as this highlight the need for countries to strengthen debt management practices and improve transparency, which is fundamental to sustainable financing. However, addressing these challenges will require countries to make tough fiscal choices to prevent debt burdens from becoming unsustainable. A prudent debt management strategy is thus key to tackling this challenge. There is a wide consensus that countries need to raise more domestic revenue to make debt financing more sustainable. There are also needs to be a greater focus on improving the efficiency of public spending in such a way that it helps to improve economic growth. While the primary responsibility for avoiding the build-up of unsustainable debt lies with the borrower, creditors also have a role to play in encouraging greater transparency. Irresponsible borrowing ultimately contributes to unsustainable debt burdens. More recently, the Debt Service Suspension Initiative, which was endorsed by the G20 finance ministers and central bank governors on the 13th of April this year, has come under renewed focus as a means to addressing the debt burden on the continent. The DSSI, as it is known, seeks to grant debt service suspension to the poorest countries to mitigate the impact of the pandemic. Its objective is to create fiscal space for countries to increase their social, health, and economic spending in response to the crisis. The suspension of the resumption of repayments will be over a period of 3 years, with a year grace period. Some see benefits associated with the DSSI, while others have indicated that an application of DSSI participation might send a negative signal about countries' credit worthiness. The three major credit rating agencies have stated that private sector participation in G20 should be on comparable terms, and that it could have negative rating implications for participants. More recently, Moody's placed 4 African countries on review for a downgrade for their participation in the DSSI, stating that this raises the risk of losses for investors in the country's bonds. This presents a dilemma. How can we ensure that debt service relief does not lead to sovereign downgrades and thus compromise the attainment of debt sustainability over the medium term? This is an issue that is receiving increasing attention on the G20 agenda. And I guess that's why this conference is organized by the law faculty, because lawyers are going to be very busy. In closing, I wish to reiterate that public debt has an important role to play in financing development, particularly in augmenting government budgets. However, it should be clear that debt is not a replacement to domestic revenue mobilization. All that debt does is to bring future revenues to today so that you could actually smooth the expenditures. But meanwhile, with the debt levels that we face, we must actually make sure that they are sustainable so as not to undermine market confidence. To ensure that debt plays a meaningful role, it must be utilized for revenue-generating activities that increase the productive capacity of the economy. Or simply, it should be utilized in investments that raise the productive capacity of this economy. I look forward to hearing some of the novel ideas during this conference, and that will be shared in the next session on how we can tackle challenges confronting the continent. Let me apologize for the long address, for I didn't have time to write a shorter one. Thank you very much for your attention.
Thank you very much, Governor, for a real tour de force. It was a a perfect opening for this conference. Not only did you put the issue of sovereign debt in its historical context, but you also showed us how the particular problems of Africa feature and the particular challenges that Africa faces dealing with the COVID conundrum now. And you also showed us some of the policy responses and challenges that the conference both this year and going forward. I hope we still have about, but invite people if they have questions to play. For the continent, and it looks as if the global response has not been particularly forthcoming. You mentioned the DSSI and the challenges involved in taking that up, and so I was wondering, in the event that the rest of the world proves not to be as generous and helpful as it could be, what can Africa do on its own to manage the crisis and to reduce the burden so that it's not as dependent on a response from the rest of the global community?
Yes, Jenny, that is when you say what should Africa do, we need to be understanding the following. African countries are in different situations. There are countries that have run very prudent macroeconomic policies, and those countries would be able to weather this storm. They have got the space to do this. There are countries like South Africa which have got sophisticated bond markets and can fund itself in the domestic market. So when we talk of this relief, we are not talking about those countries. We are talking of countries that are really poor. And earlier I mentioned the fact that President Ramaphosa had appointed this group of what he had called COVID-19 envoys who must engage across the globe with multilateral forums, with creditors to arrive at a solution. And I think that the best the continent could do for itself is to basically engage with that DSSI and ensure that we get the best terms out of that DSSI. I must say that rating agencies deciding that participation in the DSSI necessitated a downgrade just suggests that they had once again missed the boat. It's like shouting fire in a crowded hall, because unless something is done for these highly indebted countries or countries that are in debt distress, what you would actually face is a real default. And so for the continent, we are going to have to engage. But as we engage with this, and when I said this thing in jest that lawyers are going to be very busy, is that we don't have a London club or a Paris club to go and negotiate with. You are having a very broad creditor base, varying from banks to pension funds to insurance companies to even hedge funds. And so the negotiations are going to be tough. And I think as we have seen the negotiations of Argentina that had taken place, that you have creditors that can actually hold out and make a deal difficult. And so for the continent, it would be useful to negotiate this thing as a bloc. But there is a resistance from creditors because they say the continent didn't borrow as a bloc. You borrowed as individual countries, and we would like to negotiate with the individual countries. This then brings us that in addition to the DSSI, that we look at the IIF, the International Institute of International Finance, principles on fair debt restructuring and stable capital flows, because that lays the basis and will ensure that everyone who restructures debt restructures it in accordance with commonly agreed principles. There might be a need to refine the principles, but I think that they lay a basis on which you could engage with the creditors. Danny, if you have not, yes, I was saying you must unmute yourself.
Yes, thank you. It doesn't look like anyone has a question, so I'm going to ask you another question. Well, the two questions maybe. One is, do you think, as you talk this through and as your talk about the jobs for lawyers makes me think one of the problems African countries experienced out of the HIPC initiative was the problem of vulture funds, which are another word for speculators and holdout creditors. Do you see that as a particular risk now? And then the other question I was going to ask you is, in your role as chair of the IMFC, is there more that the IMF could be doing to deal with Africa's situation at the moment?
Thanks. Thanks, then. Look, the issue of vulture funds was not much of an issue in the HIPC initiative. Because with HIPC, we dealt with multilateral and bilateral debt. And so that was much easier to deal with. That issue of vulture funds becomes an issue now, because the debt is in the hands of private creditors, and it is tradable. So it is not unthinkable for a vulture fund to go and pick up a couple of millions of debt and hold out when the negotiations come. That is what we are going to have to confront and have to deal with. And that is why the importance of these principles being adhered to becomes important. Your second part of the question, I forgot.
I was asking about the IMF, and if you
the
think
IMF,
there's anything more there.
Look, I mean, this becomes also a fairly interesting one. I mean, one of the things that came was what happens with the debt of the IMF and the World Bank. And for many of these countries, they have the debt of the multilateral development banks. And you've got to come to the party with the MDBs. But when you come to the party with the MDBs, remember, the shareholders of the MDBs are the countries themselves, which would mean that when you do that, you might have to put more capital into the MDBs. The IMF, coming into this crisis, the need to respond had a lot more to do with availing resources for countries to be able to respond to the pandemic. And it had to be facility, the rapid disbursing facility, had to be a facility that could disburse quickly, because once you were busy negotiating debt over a period of time, people are dying from the virus. And countries needed the resources to be able to respond to this pandemic. And the deliberations in the IMF had focused on just that, and ensuring that the IMF has got the firepower to respond. Interestingly, the mobilization of resources for the IMF had turned out to be better than for the World Bank. The IMF has got much more firepower to respond to this pandemic than the World Bank has.
Thank you. Your answers have precipitated a number of questions and comments. The problem is I'm not sure if I can work out if I'm allowed to allow people to ask questions. But Matthias Goldman, I know, wanted to ask a question. Matthias, if you can unmute yourself, then please go ahead and ask a question. Are you there, Matthias?
I've already answered this question, it looks like.
You stunned him into silence. If he said submitted in the box, I'll ask him. One of the questions that came in the box from Salim Fakir was about whether the Reserve Bank is engaging in quantitative easing, and if not, what the difference between what you're doing and quantitative easing would be.
That sounds like a very South African question.
It is.
You know, yes, we have bought government bonds, and we have done so because of a particular reason. We did it because we saw a dysfunction in the market. And so, based on that dysfunction, we felt that we duty bound to ensure that the market continues to function. Why? Firstly, our own execution of monetary policy depends on a system that is running on a collateral system. If the market is not functioning, it is difficult to price, to attach value to that collateral. So we had to get the market to function. Secondly, is that the South African government funds itself in the bond market on a weekly basis. If the market is not functioning, we can't be sure that the government is getting a price that is reflective of the demand and supply of funds in the market. So we had to do what we did. Quantitative easing is an instrument that is available to central banks. When central banks embark on quantitative easing, they do so based on the circumstances that they face. So at the moment, we have been using the interest rate policy tool that we have. And the reason we use the interest rate policy tool is because it meets the circumstances. We were able to provide regulatory relief to the banks to continue to get credit to flow, and that is because it met the circumstances. We have decided not to do quantitative easing because it doesn't meet the circumstances. What are the circumstances under which you would use quantitative easing? You have got to have inflation so low that it actually threatens to lead you into deflation or closer to zero. Secondly, it must be that interest rates have dropped so low that they had become ineffective as a policy instrument. And so when prices no longer function, then you start to use quantities, and that's when you buy government bonds and other bonds if necessary. Countries in the developed world did it, but they could do it because part of it is that they are having their reserve currencies. In spite of the US Fed embarking on quantitative easing, you still saw the dollar strengthen. People still wanted to have the dollar. That's because they are a reserve currency. And that is the similar story whether you look at the Euro area or you look at the UK or even Japan. If you have a reserve currency, you can do these things. And as one of the US policymakers used to say some years ago, the US dollar is our currency and your problem. Now, so they can do these things. The South African rand is our currency and our problem. We do not have the scope that the US has when it embarks on quantitative easing, especially in the circumstances where you still have policy.
Thank you, Governor. That, I think that answered the question very clearly. I said we would finish at 4 o'clock, and it's exactly 4 o'clock. So I think we should declare this session and closed. And thank you very much for a really stimulating beginning to the conference. As I said, a talk that it was a real tour de force that has set a high bar for what follows in this, has given us the context for the papers that we'll be concentrating on in the sessions going forward. I want to thank you very much for taking the time to speak to us today. I want to thank also the Vice Chancellor and the Dean for being with us and for helping to introduce you. And to say, we'll declare this first session closed. You're all most welcome to stay for the second session, but I know you have very busy schedules, and so we will understand if you're leaving. For the rest of the participants, we're going to shift now to the panel, and in the transition, I know Anna Gilpin had some announcements she needed to make, so I'm going to hand over to her as the speakers leave, and we switch, and then I'll introduce the speakers for the next session. So thank you very much, everyone.
Thank you to the Governor and to the Dean and the Vice Chancellor for this opportunity. As we transition to the next panel, I wanted to flag a couple of things. First, that we will have captioned videos of all the panels and all the sessions throughout the 2 weeks. And we're able to do this because of some very generous supporters, in particular, the International Insolvency Institute. They're also hosting the closing session for the conference on the 18th. The Cleary Gottlieb law firm, and the Netherlands Ministry of Finance that is supporting the Sovereign Debt Forum, which is the umbrella initiative under which the DebtCon conferences take place. And then, of course, this is a chance to thank the many, many folks that have worked around the clock over the past few weeks, shifting from an in-person conference on the outskirts of Florence to a 5 time zone, 5 continent, 9 country, 10 host team Sovereign Debt Olympics. And in particular, of course, the folks at the Institute of International Economic Law at Georgetown, Marie Kasparek and Meha Jain, and the fearless law students, Jordan Matoyer and Nathan Gelfand-Toutant, who have just really been coordinating this worldwide event at every hour of every day. And I don't know how you do it, folks. And the media teams around the world with CPR and IEL, thank you. Thank you again to all our hosts. Thanks to Hugo. And remember, there are videos that are going to be posted on all the conference websites. So if you had trouble with your tech, fear not, DebtCon will always be there for you. Again, thanks to everyone, and I hand it back over to Danny.
Thank you, Anna. I should add to the thanks to thank people who here in Pretoria have been working to make sure this works as well. To our tech expert, Simpiwe Kumalo, and to my team at IDLU, Tandeke Rasesoke, Magali Masamba, and Marie-Louise Aron, who've really been very helpful in putting this together. As you know, we're now going to switch to the first panel, which consists of 4 speakers, 3 papers, and a commentator. I know from looking at the papers we're in for a very interesting and stimulating session. What I think I'll do in the interest of keeping us the discussion flowing is I'll introduce the 4 speakers in the order that they'll speak, and then we can just roll from one speaker to the next. And as we saw with the last thing, please put your comments and questions in the chat box, and we'll ask them at the time. It seems that it's not possible to actually activate anyone, to unmute someone and allow them to ask the question directly. But if you put your questions in the box, I'll be happy to put them with attribution to the speakers. So let me introduce the speakers first. The first speaker who will speak on interest holiday provision is Rodrigo Olivares Caminal, who's a professor of banking and financial law at the Center for Commercial Law Studies at Queen Mary University of London. Prior to this position, he was a lecturer and a senior lecturer and an academic director for the Center for Financial and Management Studies at SOAS at the University of London, and is taught also at the University of Warwick. He's also taught in many universities, many law faculties and business schools around the world, and has acted as a sovereign debt expert for UNCTAD, the UN Conference on Trade and Development, and as an international insolvency expert for the World Bank IFC, as well as working with private financial transactions. The second speaker will be Strato Pahis, who's an acting assistant professor at New York University School of Law and a lecturer at the University of Pennsylvania School of Law. He'll be speaking on bits and bonds, the international law and economics of sovereign debt. He's lectured around the world, worked in the private sector with law firms, and has published on these issues in many leading journals. And his paper actually, as I understand it, will be published in the American Journal of International Law later this year. The third speaker is Mark Walker, who's going to speak on a stabilization fund for countries facing market turmoil. He's the senior managing director and the head of sovereign advisory services at Guggenheim Partners. He's worked on sovereign debt issues for over 40 years in countries all over the world, and in most of the complex sovereign debt cases of the last 40 years, Mark has probably been involved in some way in almost all of them. Prior to joining Guggenheim, he was the head of sovereign advisory at Milstein Company and at Rothschild in London and at Lazard in Paris. He also was the partner at Cleary Gottlieb, Steen and Hamilton, as well as the firm's global managing partner. The commentator who will talk about how all these papers relate to Africa is, and we're extremely privileged to have her join us, is Mrs. Elsie Ado Awadzi, who's the second deputy governor at the Bank of Ghana, where she's responsible for the regulation and supervision of banks and other financial institutions, for financial stability, as well as a number of other issues relating to the Bank of Ghana. Prior to this appointment, she worked as a senior counsel at the IMF and has worked as a commissioner for Ghana's Securities and Exchange Commission. She's also published many papers on this area as well. So as you can see, we have an extremely well-qualified and experienced panel to start this discussion today. And so without that, I'm going to get over the way and hand over to Rodrigo to present his paper.
Thank you, Danny. I guess that everybody can hear me. Danny, just before we start, for housekeeping matters, Elsie or Danny, I don't know who knows the answer to this, but I assume that it would be 15 minutes or so, right?
Yes, so if each of you speaks for about 15 minutes, then that'll give us a good amount of time for discussion and questions at the end.
Okay.
Do you need me to give you some time guidance, or you're okay?
Hopefully not, but if you see that I'm exceeding, please, by all means, give me a red card.
Okay.
Thank you. Let me share my screen now. I assume that you are all seeing the slides now. So what I'm going to be talking about is about interest holiday provisions. And I'm going to start by basically doing a backwards analysis. Basically, we look at first whether sovereigns can go bankrupt, and from there I will discuss the difficulties that sovereigns usually encounter, and then look very briefly at what is the current framework to deal when sovereigns are in distress, And then looking at what are the available tools, then I will focus particularly on one. And from there, I'm going to start building, which is the hurricane clause. And from there, I'm going to start building towards what's this concept about these interest holiday provisions. So the first question that we should ask ourselves is, when sovereigns get into difficulties, where they can go bankrupt. In order to answer that, what we need to look at is whether a sovereign has liquidity issues or solvency issues. And what we need to understand is whether liquidity, or mainly the solvency issue, whether it is a legal notion or a financial concept. And clearly in the case of sovereigns, they will not be subject to a bankruptcy law. And then if we analyze it as solvency as a financial condition, what we need to look at is whether it is really a problem of solvency, or it's a liquidity issue. And then we will have to analyze whether it's a short-lived temporary problem or medium to long-term problem. Because in my view, sovereigns cannot go insolvent. They can increase taxes, they can privatize, they can expropriate, they can dispose of assets. So from a legal point of view, sovereigns cannot go insolvent. So for me, the focus is on the liquidity side of things. So when we look at liquidity, what we need to look is, or try to understand, whether it's temporary, short-lived, and triggered by shocks, either endogenous or exogenous shocks, or whether it's medium to long-term rooted on structural problems. Why I'm saying this? Because basically, if it's the former, temporary, short-lived problems, I think that can be relatively easily resolved. If it's medium to long-term structural problems, then most likely you will need a full-blown restructuring. So when we look at quickly at the big map of what is the landscape and where we stand, what we need to look at, or what we need to focus, is this distinction. Here we have official sector or private sector debt. And then, so that's kind of a quick dividing line where we have official sector on one side and private sector on the other. And then draw a quick horizontal line dividing how the financing is obtained, and eventually, when there are difficulties, how things are resolved. And here we have at the bottom the sovereign debtor. The focus of today will be here on the contractual terms, because commercial bank debt and bond financing, this is governed by their contractual terms. And these contractual terms usually have plain vanilla, straightforward provisions, which are usually seen in any of these debt arrangements. You will have a negative pledge, pari passu clause, cross-default clauses, waiver of immunity, submission to jurisdiction, etc. However, then you will have some funky stuff or slightly more esoteric provisions that you might encounter on some of these instruments every now and then. And one of them is the hurricane clause, which is what I will be talking about today. And just as a bit of a background, how all these emerge, how these take place, and I'm using Grenada as a case study. Grenada is an island in the Caribbean where basically it was in 2004 hit by a hurricane, Hurricane Ivan, which was the 6th most severe hurricane in the Caribbean history. Basically, it produced a huge damage, affecting 90% of houses in the country. 70% of hotel rooms in Grenada were not being able to be used for tourism, tourism being one of the main sources of income, the other being nutmeg trees, which is the main export commodity of Grenada, and they were largely affected, and pretty much 70% of all production was affected. there was a high unemployment rate, and they had to resort to a restructuring. The government worked on an actual proposal to restart the debt of Grenada, and 10 months later, just prior to launching that restructuring offer, they were hit by another hurricane. So this exacerbated the losses. And in the latest deal, because after that, then they had to restructure again, and Grenada realized that they were prone to hurricanes, and that as it has happened in the past, hurricanes every now and then can seriously affect the economy, and to an extent, they can produce some difficulties in servicing the debt. So that's why Grenada's debt now includes a hurricane clause, which is basically if there's a tropical cyclone event, there will be a temporary suspension of debt servicing obligations in order to be able to respond to that external shock. So what was required is a loss certification, that the loss is in excess of a predetermined amount, and then the sovereign will be allowed to defer up to 3 debt payments, namely interim debt payments, namely interest, and this interest payment will be added to principal, and they will be paid upon maturity. What's the great upside of including a provision like this? It basically, it produces immediate liquidity following a shock. This will prevent, since there's a built-in mechanism within the contract, it prevents a default. It will work like a predetermined standstill period for a given period of time, while the country manages to cure this external shock that has produced that derailment in the possibility of servicing the debt. So this is a new approach which can be seen as a disaster risk management tool, and it's an ex-ante approach that allows to anticipate and manage the cost of adverse external events. And what are the benefits? As I have recently explained, the benefits are mainly an immediate cash relief that provides some fiscal space for the sovereign to be able to deal and attend with the most urgent matters. This prevents a payment default and also prevents the need of the restructuring. Why a restructuring? Because it does not necessarily mean that we are dealing with a medium to long-term structural problem of the country. It's something which is temporarily, short-lived, and that you can overcome the difficulty by just gaining some temporary breathing space. So if we think about this, and then what we need to ask ourselves, why should we just limit it to hurricanes? And thinking of the African continent, what we can think is, what about floods? What about droughts or locust infestations? So why do we need to just link it to one event, which will be hurricanes? So that pretty much brings us into, okay, if we can identify and predetermine what will be the triggering event, we can build a clause that can serve that purpose. But then, I'm thinking of the times that we're living at the moment with the pandemic and what has happened with DSSI, and this was in part inspired by a transaction on which I've been consulting with the private sector on a creditor committee about why can't the sovereign just take an interest holiday just because. Don't get me wrong, and don't take this completely out of context. That just because is why do we need a natural disaster? Why it cannot be simply an exogenous or endogenous short-lived shock, be it self-inflicted or be it an external shock? And that's why I started thinking about the possibility of the inclusion of interest holidays with a non-specific event. However, here what we need to think is whether there's any other corrections needed. And basically, in order to trigger it, probably we can link it to a GDP shrink percentage. And it will work pretty much like a hurricane clause where the certification of the damage will be, for example, it can be measured by a shrink in a percentage of the GDP. And then maximum of triggers, well, that's to be determined in the contract. If there are too many external events, probably will be worth limiting contractually to, let's say, interest holidays can be used once throughout the life of the debt instrument, and it can be used, for example, deferral dates that will be predetermined. It can be 2 or 3 interest periods. In the case of the hurricane clause, and on this slide, what I do is a comparative table between a generic hurricane clause and this proposal of an interest holiday clause, where basically you can pretty much mirror one and the other, and you can have, or you can find contractual conditions to limit the trigger, or particularly very important conditions that if you are going to trigger the clause, these conditions need to be met, because one of the main issues will be what are the further corrections that would be required in order to use one of these clauses, precisely to prevent abuses from the debtor. And this is what I refer to in whether there are other corrections needed. And the reason why I mentioned this, or why I refer to this, is that one of the common issues that you might find is that when a government is in office, usually they will try to avoid the unavoidable. They will try to delay by all possible means facing reality. And that's a common phenomenon that I have seen in more than one restructuring. And whether are we facing a second liquidity crisis, and is the sovereign just avoiding the unavoidable? And probably we can link this hurricane clause to a debt to GDP ratio to make sure that it is just a liquidity issue rather than a solvency crisis. Then if we need to, I personally think that postponing 1, 2, or 3 interest payments will just be a drop in the ocean. So I personally don't think that probably you will need to trigger a mechanism similar to a sinking fund or to a early prepayment provision where you start buying your own debt, or you will start reducing the total amount of outstanding debt just because you have postponed 2 or 3 interest periods. But if creditors think that in order to give the debtor the benefit of a provision like this, that they can take an interest holiday, it can easily come with a stick on the other end to prevent overusing this tool. The reality is that a sinking fund-like provision or a prepayment provision, it acts in the benefit of both debtor and creditor, because it reduces the total outstanding amount and makes the bullet payment upon maturity more manageable. And of course, all these will have to operate under the umbrella of an IMF program that will work with the country in making sure that this is sustainable and that the country adopts the necessary reforms to overcome the temporary liquidity problems and adopt all necessary reforms for that means. What we need to understand is that something like this probably could have overcome the issue that we are facing now with some of the DSSI initiative. And one of the other things that are important is from the private sector side. In my view, one of the main problems with the DSSI initiative is that we are seeing some situations where it's not a temporary holiday that is required, but it's more of a structural reform. So that goes to avoiding the unavoidable. And that's why I think that definitely a provision like this is going to be included in that instruments. It will have to come hand in hand with some other triggers and conditions, because otherwise it can, I personally think that basically the purpose of this provision can be distorted by the sovereign debtor. Elsie, Danny, I think that probably I will leave it there. I will be happy to enlarge and cover a couple of other angles that I have not covered in the presentation during the Q&A, but I have already taken 17 minutes, so I think that it will be fair to hand over back to you guys.
Great, thanks very much, Rodrigo. Stratos, it's over to you now.
Great, thanks so much, Danny. Thanks so much, Rodrigo. Thank you also to the organizers, to Professor Gilpin and Paneeza, Professor Bradlow, for the invitation to speak today in the University of Pretoria for hosting this session. I'm going to use my time to speak about a paper that I'm working on called Bits and Bonds, the International Law and Economics of Sovereign Debt. I'm just going to try to share my screen just a second here. See, hopefully everybody can see this. Share, all right. There you go, all right. So in my paper, I argue that international investment law threatens to throw another wrench into the restructuring of sovereign debt and to make both sovereigns and creditors worse off. I also argue that this outcome can be avoided by reforming or reinterpreting investment treaties to achieve the equal treatment of like creditors. So I'm going to structure my presentation as follows. I'm going to first give a little bit of background on what international investment law is and explain why it's become a new and potentially important institution in the sovereign debt regime. Second, I'll quickly discuss my claim that applying international investment law to sovereign debt threatens to make creditors and states worse off, and in fact to undermine the very purpose of international investment law. That's what I call the bits and bonds dilemma. Third, I'll very quickly sketch how the equal treatment of like creditors can resolve the bits and bonds dilemma. And fourth, I'll talk about what I think are some potential lessons for debtor states. All right, so first, some background on international investment law and why it matters to sovereign debt. International investment law, for those of you unfamiliar, is comprised of nearly 3,000 treaties between states, most of which are bilateral. And that's where the term bilateral or BITS comes from. It refers to bilateral investment treaties. Through these treaties, states promise certain protections to foreign investors hailing from the other state party to the treaty. So for example, South Africa and Finland have a bilateral investment treaty, a BIT. And through that BIT, South Africa promises certain protections to Finnish investors investing in South Africa, and Finland promises certain protections to South African investors investing in Finland. These treaties cover a wide range of economic activity, typically defined as any asset or all assets, and they protect those assets by way of clauses that prohibit expropriation, that prohibit so-called unfair and inequitable treatment, prohibit discrimination, and in some cases, contractual breaches. So importantly, BITs give foreign investors the right to seek damages for treaty violations directly against states through arbitration. So in my example, the Finnish investor in South Africa can bring a claim directly against South Africa, alleging that South Africa breached its treaty obligations and demand compensation for the violations. Those arbitrations are decided by ad hoc international tribunals whose members are appointed by the states and the investors. Importantly, they result in awards that are enforceable globally. And they're enforceable, in fact, much more easily than foreign court judgments. Okay, so why does international investment law matter to sovereign debt? It matters because creditors can use investment treaties as another avenue to recover on their debts, right? And this is no longer a theoretical matter. Since 2006, there have been 4 investment arbitrations brought by thousands of creditors against Argentina and Greece for claims arising out of their restructurings in the early 2000s and in 2012, respectively. So there are 3 arbitrations brought against Argentina involving thousands of Italian creditors, and there was 1 arbitration brought against Greece by a Slovakian bank and its Cypriot shareholder. So at the time these claims were brought, there was a lot of uncertainty as to whether sovereign debt was really covered by investment treaties, whether states really intended to give protection to sovereign debt through these treaties. But 3 of the 4 tribunals found that they were covered, and they admitted the claims. So it's important to note that none of these decisions is binding on future tribunals, but there is reason to believe that they will be persuasive. And that makes them important for all states, including African states, which are party to some of these treaties. I've highlighted just a few examples here of some African investment treaties. Okay, so this brings me to my first claim, that applying international investment law to sovereign debt threatens to make both states and creditors worse off and undermine the core purpose of investment treaties. It's important to note that none of the arbitrations I mentioned or that has been brought to date has been decided on the merits. So there's a big question mark as to exactly how these treaties will be applied. But I do think it's reasonable to assume that at least one interpretation of these treaties, and probably the most likely interpretation, would have 2 main effects on sovereign debt. First, it would strengthen creditors' rights and creditor bargaining power. And that's because, as compared to foreign judgments, as I mentioned, investment arbitration awards are easier and more enforceable for creditors to execute. Second, I think it's reasonable to assume that investment treaties would threaten to worsen the holdout problem. And that's for a number of reasons, including that they provide an additional forum for holdouts to litigate in. They potentially allow creditors to challenge restructurings, even where those restructurings are agreed via collective action clauses. And also because they threaten to elevate the position of some creditors above others and create some creditor asymmetry, which could make coming to a restructuring agreement more difficult. So as we know, of course, holdouts cause inefficiencies by increasing litigation costs and also by potentially undermining the restructuring of unsustainable debt. We might expect that strengthening creditors' rights, the first impact there, might compensate for the inefficiencies created by the holdout problem. Normally, with respect to investment in general anyway, we would expect increased enforcement to lead to greater efficiency. And in fact, that's the fundamental premise behind international investment law. International investment law protects investment ex post in order to reduce the risk and cost of capital and thus promote investment ex ante. But my claim is that with respect to sovereign debt, increased enforcement ex post is likely to actually increase costs and thus discourage rather than promote investment ex ante. In other words, applying bits to bonds is likely to undermine rather than promote the very purpose of investment treaties. To understand why, we need to ask why ex post enforcement is generally considered to be efficiency enhancing. It may seem obvious, but if investment is a good, which I think is the basic assumption behind the investment regime, we expect rational states to do what they can to attract it, including by abiding by their commitments to investors. But there are 3 reasons that we nevertheless might worry states would inefficiently breach their investment commitments, even if it meant that they would have a harder time attracting investment in the future. So first, states are not unitary rational actors. They have agents that make decisions on their behalf, and the interests of the agents may not align with the national interest. Second, states and their agents may overvalue the short term at the expense of the long term, and therefore maximize short term gains at the expense of long term costs. And third, investors may not have perfect information regarding states' intent vis-a-vis the investment or their history of investment adverse decisions. So all these market failures, agency problems, short-termism, information asymmetry, could lead states to act inefficiently and breach their investment commitments generally. And that's why, in theory, we have international investment law to strengthen those commitments by providing an external enforcement mechanism. But as others have observed, in the case of sovereign debt, those same market imperfections appear to lead to the opposite result. They appear to lead states to actually over-comply with sovereign debt, even past the point where compliance is efficient. And we just heard Rodrigo make mention of this reluctance to face the music and face reality and restructure debt even when it's unsustainable. I don't have time to go through each of these in detail, but I will note that what we observe is consistent with this. In contrast to other investments, the predominant problem with respect to sovereign debt is over, not under compliance. The consensus has shifted from a concern that states may default too much or too often to a concern that debt restructurings have often been too little and too late. Right? And I'm quoting the IMF here, though others, some among us today, have made similar observations. And as the governor mentioned, the problem with waiting too long to restructure and then restructuring too late is that unsustainable sovereign debt burdens lead to deadweight losses that can fall on both creditors and states. And again, to quote the IMF, again, allowing unsustainable debt situation to fester depresses investment and growth, can raise the eventual magnitude of debt problem and reduce the economic value of even creditors' claims. So this brings me to what I call the bits and bonds dilemma. That instead of reducing the cost of sovereign debt, investment treaties threaten to increase it in 4 ways. First, they threaten to do so by increasing creditor leverage, and therefore causing states to restructure even less and even later than they already do, and thus increasing the debt overhang associated with unsustainable debt. Second, in addition, as already mentioned, they threaten to exacerbate the holdout problem. And because holdouts can undermine the restructuring of sovereign debt, they also threaten to lead to more debt overhang. And of course, holdouts increase litigation costs. And finally, in addition, because of the ad hoc nature of investment arbitration, BITs threaten to introduce uncertainty costs into sovereign debt. So my second claim is that this dilemma can be resolved by treating all creditors equally and going no further. So the equal treatment of like creditors resolves each of the inefficiencies I just described. First, it would prevent investment treaties from worsening the too little, too late problem, because equal treatment wouldn't actually increase creditor leverage and therefore lead states to disperse additional payouts to creditors. It would just require the equal treatment of what is paid out. And so that eliminates the extra debt overhang associated with increased creditor leverage. Second, it would disincentivize holdout arbitration because it would limit holdouts' recovery to what other like creditors recovered in a restructuring agreement. And so they'd have no incentive to hold out in the first place. And that would eliminate holdouts' negative impact on restructuring and the additional litigation costs associated with holdout arbitration. And finally, equal treatment would reduce the chance that some creditors recover more than others and thus mitigate distributional uncertainty. So in my paper, I show how treaties could be reformed or reinterpreted to achieve this outcome. I don't have time to get into all the interpretations now, but I'm happy to discuss this during the panel discussion and Q&A. But the interpretive solution I propose really depends on four questions central to international investment law. So before getting into lessons for states, I just want to emphasize very quickly why I think it's appropriate to adopt the interpretive solution that I advance. And that's for 3 principal reasons. First, despite the fact that investment law tends to apply the same rules to every asset, not every asset is the same, right? And because not all assets are the same, it may not make sense to treat them the same. And this point may seem obvious, In domestic law, we have different rules for property, for contracts, but investment law doesn't actually distinguish between those different types of assets. As a general matter, it applies the same protections to contracts as real property, as sovereign debt, etc. The problem is particularly pronounced as one size doesn't fit all. Problem is particularly pronounced because international investment law is generally understood to be mandatory, meaning that states and investors can't actually contract around it or out of it. The second reason that an interpretive solution is desirable or acceptable is that the applicable rules of investment law are actually flexible enough for interpreting them in a way that is tailored to specific economic and legal realities of particular transactions. And the third reason why this is acceptable and desirable is that the Vienna Convention on the Law of Treaties actually calls for investment treaties to be interpreted in light of their context and purpose, right? And that counsels for using the flexibility built into investment treaty norms to adopt interpretations that advance the core goal of investment treaties, investment promotion, and then avoid interpretations that undermine that goal. And so that's effectively what my interpretive proposal does with respect to sovereign debt. But that flexibility comes with its own costs. It means that investment arbitration becomes even more unpredictable and makes it more difficult for states and creditors to anticipate the impact of investment law ex ante. And so flexible interpretive solutions like the one that I propose are really just the second best solution. And so this brings me to my last point, which is lessons for states. First and foremost, states need to improve on treaty design. They need to reform, including by reforming treaties to either exclude sovereign debt entirely or to limit the protection they offer to sovereign debt to claims for discrimination. Treaty reform, of course, takes time. And so in the meantime, states with distressed debt should be aware of potential exposure to investment law claims. And they should also consider issuing interpretive statements of their investment treaties together with their counterparty states. These interpretive statements, they don't need to be made in the context of an arbitration that can be made before. And they could argue that the states who are parties to these treaties didn't mean for the treaties to cover sovereign debt, or they could argue that they meant for these clauses to be interpreted in a way similar, for example, the way I advocate in my paper. Interpretive statements are not always determinative, but they are sometimes persuasive to tribunals. States should also consider in the future bond covenants that disclaim international investment law claims. Again, as I mentioned, international investment law is largely considered to be mandatory, and therefore states cannot contract out of it. But some tribunals have indicated they might, again, the operative word might, give effect to an express waiver. Finally, states should be prepared to make some of the interpretive arguments I outlined in the paper in the event they do find themselves defending against investment law claims. As I said, an interpretive solution to this dilemma is not optimal, but it may be one of the better options that countries have to work with for now. So thank you very much, and I look forward to the discussion.
Great, thanks, Stratos. Mark, I'll hand over to you.
Thanks very much, Danny. Let me start just by thanking briefly Anna and Hugo and everyone else who has participated in organizing these conferences. I think they're a great event, and the fact that you all have been able to repeat them year after year is a testament to how important and how successful they've been, and I'm honored to be invited once again to speak. What I want to do is to talk briefly about a way to provide additional resources to countries in distress, particularly resources coming from the private sector. Governor Kganyago gave us at the outset this morning, today's conference, a good, I think, analysis or description of where we are. To summarize very briefly, the pandemic that we're all witnessing has created a global public health and economic shock of unprecedented proportions. And although the official sector has made, I think, enormous efforts to provide resources through rapid financing facilities, facilities that do not have conditionality, at least don't have conditionality ex post. Nonetheless, I think the resources made available are clearly inadequate. And we see that many countries, particularly in Africa, as the governor noted, are on the verge of or in debt distress today. So I think what we need to do is to find a way to have additional resources, but additional resources that can be made available without themselves contributing to debt distress. Because normally if you add debt, you also add debt service requirements. And so in a way you can make things worse at the same time as you make them better. Up to now, the private sector has shown an unrelenting and I think uniform disinterest in, or uninterest, I should say, a lack of interest in providing support other than in one-off restructurings. I mean, we've seen Argentina, and Ecuador. Argentina's dilemma predated COVID, as we all know. And Ecuador too was in difficulty before COVID. But DSSI, I think, illustrated amply the inability or unwillingness of the private sector to provide relief. And I think we should recognize that no amount of effort to shame the private sector will persuade them that they should make investments which they consider to be financially unsound. If there's a restructuring that is required, the private sector can be persuaded to participate, even short of a default. We've seen that time after time, and we're seeing it now. But short of that, to come in and participate in added financing as opposed to restructuring, new money as opposed to modifying the terms of existing financing, has been a real challenge. So I and colleagues have looked at a number of ways to try to provide incentives to the private sector to add funding. We've looked at facilities that would provide loans. They have some of the problems I mentioned earlier, which is they add to debt distress to the extent that they increase the debt service burden. And we looked at different ways of trying to provide credit enhancement. At the end of the day, I think credit enhancement comes from only one of two or three different ways. The easiest to implement, but the one that causes great political difficulty, is to have partial guarantees or equity or donor funds provided by the official sector or by bilateral sector. This money is not necessarily going to be lost, but it's a way to enable the countries in distress to access private sector funds at interest rates and on terms that are favorable, reflecting the guarantees. And the guarantees need not be 100%. They can be partial. They can be tiered so that you have some guarantors or credit enhancers providing first loss coverage, others second loss coverage, third loss coverage, and so forth, in much the same way that insurance is constructed. And indeed, there have been in the past efforts to use insurance schemes in order to provide credit enhancement. The problem in this case is I don't think the private sector is likely to provide the insurance. Other ways to provide incentives are, particularly in the case where a country is going to have to restructure as well, to provide preferential treatment in the restructuring to private creditors that put up new money. And this is something that has been done and discussed, and I think generally acceptable to the private sector. So, for example, a private sector investor that provides new money on terms that are reasonable could be given better treatment in the restructuring, could be given better access to debt equity swaps, and so forth. And there are a number of things that have been done and could be done in this regard. And it's not really very different. In fact, I think it's much more attractive than the distinctions in treatment that we've seen recently in the Argentina and Ecuador restructurings, where a preferential treatment was given to people who voted in favor of a restructuring, even as opposed to as against other creditors who were brought into the restructuring through operation of collective action clauses, but in the first instance voted no. So I think we should take for granted that one way, if not the only way, to bring in additional private sector funding is through credit enhancement. Well, I think what we've looked at most recently is a model based on stabilization funds. At the national level, as many of you are familiar, countries, particularly those with strong resource bases, natural resource bases and exports of commodities, have for a number of years, Chile is one, other countries in other parts of the world as well, Mexico is another, have created a stabilization fund where they in times of high commodity prices and strong export performance, they set aside a portion of the revenues derived from the exports as a fund to be made available in future periods when export prices decline or export revenues decline, in order to smooth out the resources available to the government to finance and fund government expenditures, and to create a more level path and more certainty that projects begun or needed to be done will not be interrupted periodically according to the vicissitudes of commodity markets and cyclical developments in those markets. But many countries, including countries in Africa, don't have the natural resource base which would form the predicate to form a stabilization fund, or may have it, but it would take some time before they can develop the surpluses needed to fund that, particularly now when commodity prices are, in almost every case, if not at a low, well below levels that people would consider surplus. What are the advantages of funding this way, and how would it work? The advantage is that if money is made available to a country using the model of the stabilization fund, it doesn't have the attributes of debt. Rather, the funds are made available when the cycle turns negative, when commodity prices are down, or whatever macroeconomic variable is chosen to be the trigger for disbursements and repayments to the fund. It need not be a particular commodity. It need not be a single variable, but the model has generally been a single variable with a commodity. So the idea would be, in times of when things turn negative and periods of underperformance, a country would be able to draw from the fund, would be able to disperse from the fund, but its obligation to reimburse the fund, to replenish the resources of the fund, unlike debt, would not be scheduled like debt. It would not provide for specific payments to be made on specific dates. Rather, the obligation to replenish the fund would be predicated on a period of overperformance, when commodity prices or the economic variable turns positive and the country is doing better than otherwise would. It's a counter-cyclical approach that provides that in effect says to the country, put money aside or replenish the fund in this case when things turn positive, but you have funds available to disperse when things turn negative. Because there's no fixed payment schedule, either as to amounts or as to timing, you don't have the same burden that you would have with debt. So how do you fund this mechanism in the absence of a fund to begin with that you've created by setting aside surpluses? The proposal is that the official sector help to organize a special purpose vehicle which would fund itself in the market. Credit enhancement would be provided by partial guarantees, by capital, by SDRs, for example, which, because a number of countries have surplus SDRs, even without a new allocation of SDRs, potentially by donor grants. And based on that, the fund would go into the market and borrow, ideally long-term. It could borrow very long-term. It could even issue perpetual bonds to relieve any pressure on the countries that benefit from the fund to have to repay the amounts that they've drawn before things turn positive. At the end of the day, at some point in the future, presumably the SPV, unless it continually replenishes its resources by refinancing, which it certainly can do, unless it does that, at some point in the day, the disbursements will have to be converted into more traditional debt with some sort of a repayment schedule in order to enable the special purpose vehicle to retire its own liabilities, if to the extent that that's the way it's been funded. There are a number of ways in which this fund could be used. It could be used to be set up to support a single country, and we're in discussions with one country in Africa today that is interested in it. It could be used to create a regional fund, a larger fund that would have resources available to provide support for a number of countries in a region, and in that case could be supported by a regional development bank. It could be used to provide new money component alongside a debt restructuring. And I think that's of particular interest because right now getting new money in with restructurings is very, very difficult, if not impossible. And lastly, it's a model that could be used not just to provide funding from the private sector, it could be used by the official sector as another way for it to provide funding to countries in need. The official sector could do it, in fact, could turn around and borrow from the private sector in order to raise funds, but that's the tantamount to lending to the official sector itself. The only last remark I would make is although I think this is a useful mechanism, and it's one in which, notwithstanding the reluctance to issue guarantees, a number of people at the IMF and the Inter-American Development Bank and elsewhere have shown an interest. I don't think it's a substitute. It shouldn't be viewed as a substitute for debt relief. This is not a substitute for restructuring. It's not a substitute for reprofiling. It's not a substitute for haircuts. There is a need for new money in many cases, but there is also a need to deal with existing debt to the extent that it's already at a level that's unsustainable. But I think it's a tool that's of interest to provide support, particularly today where the demand for funds vastly exceeds the resources available. Thank you very much.
Thank you, Mark. Let me hand you over to Deputy Governor Adawati.
Thank you, Danny. Let me start by saying a big thank you to you and Professor Gilpin and all of those who've helped in arranging this conference, particular to the University of Pretoria's International Development Law Unit, as well as the Georgetown's International Economic Institute of International Economic Law, which I'm very privileged to have been associated with since my days as a student there. Let me also say from the start that the thoughts that I'll be sharing, although very much shaped by my central banking status, are entirely my own and do not reflect the official position of the Bank of Ghana or the government of Ghana as a sovereign borrower. Let me also say thank you to Rodrigo, Stratus, and Mark for the very insightful presentations on these new mechanisms that they propose for dealing with the expected wave of sovereign debt distress around the world as a result of the pandemic. All three papers offer very thought-provoking lessons or ideas, and it is my job now to try to apply these to the African context. Governor Kganyago very excellently painted a picture of what we might call the African Dex Conundrum. And let me do my best to reiterate some of the key points that he made. Number one is that Africa is particularly vulnerable at this time as the pandemic continues to worsen fiscal positions and also reduce external reserves relative to external debt. That's a very important consideration to keep in mind. The burden of debt servicing continues to increase while revenues dwindle. And even in countries with sovereign wealth funds in Africa, we've seen that surpluses have dwindled. And in fact, countries have had to even rush to parliament for amendments to spending rules. So even before the pandemic sort of took effect in Africa, the IMF had estimated that about 16 sub-Saharan African countries were either at high risk of distress or in debt distress. That's a very important point. So there were pre-existing conditions that have somewhat been exacerbated by the pandemic. As the governor rightly observed, not only has the stock of Africa's debt grown exponentially since the HIPC/Paris Club relief in the early to mid 2000s, where about 30 or so African countries got substantial debt relief, the structure of Africa's debt has also changed, largely from official sector debt to more market-based debt, very high yields attached there too. It's also important to recognize that the maturities have also been extended. So let me give you an example. Ghana's first Eurobond issuance in 2007 was for 10 years, and that was a big deal at the time. Fast forward to more recent years where Ghana, Cote d'Ivoire, Kenya, Egypt, Senegal have issued up to 30-year Eurobonds. So the maturities have also gotten longer. So it is extremely important, before I get into the lessons learned and the perspective shared by the three prior speakers to the African context, I think we need to understand something the governor said as well, that for a number of African economies that have been able to attract external debt, market-based external debt in the last decade and a half or so, a lot of this market access has been hard-won, if you will. It hasn't been easy. A lot of these economies also remain frontier economies, apart from South Africa, that is, G20 and a member of the G20, and that has had a longer experience in issuing external debt, market-based debt. South Africa's Eurobond debut, it goes way back to 1995, but a lot of the if you will, Eurobond issuers in Africa have been doing this for maybe only last 13, some even more recent. And so these borrowers are still trying to walk a very tight rope, understanding the dynamics of international debt market and what this means for them going forward. It may be obvious that as a result, African sovereigns live in trepidation of investor reaction to the slightest hint of potential debt workouts. And this is further complicating matters because real and honest discussion about options available for making debt more sustainable in these times is a bit difficult, and this could actually lead to some disorderly defaults. Maybe, hopefully not, but there's a real potential there. So what are the options for African sovereigns? Do existing debt contracts provide sufficient flexibility for workouts if needed? The IMF reports that as of 2019, 14 African sovereigns have included enhanced CACs and modified pari passu clauses in at least some of the international sovereign bond issuances since October 2014. Will this help? So there comes the thoughts that have been presented by Rodrigo, by Stratus, and by Mark. So let's take the first thought, the first proposition made by Rodrigo, which is the temporary interest payment holiday. This, as well as the synthetic stabilization fund idea proposed by Mark, are all premised on cyclical rather than structural downturns. My first question there would be whether the African debt situation is cyclical or structural. You heard from the governor very important observations about the structural deficits that have pertained in the African context for quite a while, long before the pandemic came on board. So is that for Africa, is it a cyclical problem? Is it a structural problem? Is it both? And what does this mean for the application of mechanisms like these? Then looking at the temporary interest payment holiday idea, it sounds like a very good idea that could be explored. And it's particularly important to note that it's been used in some of the island countries like Grenada, a country that I was privileged to work on at the IMF. The question becomes for me though, whether this could not potentially increase the cost of borrowing for African sovereigns. Already, African risk premia are some of the highest in the world, and I think that this is something the governor alluded to as well. How do we ensure that a clause that whose application is at the sole discretion of the sovereign borrower in Africa would not sort of increase the premium even more? Worsening the already difficult debt situation. So I do note that the idea is for some kind of a mechanism to reduce the overall principle of debt with time. But I think that a little bit more clarity around how that would actually work would be important. The other question there for me is that a hurricane clause is pretty sort of easier for me to apply because hurricanes are force majeure type events and everyone understands this being a hurricane. But otherwise, especially when you're dealing with a lot of structural weaknesses already, how does the creditor trust this mechanism? How does the creditor trust that moral hazard will not actually result out of these clauses? Again, we're invited to think of perhaps some IMF type program that would hold things in balance if these clauses were to be applied. That would then presuppose that there's a balance of payment crisis and not just a debt problem. And that might actually be also difficult to put in the mix. So that's something that we need to think about going forward. Also, given that debt contracts already exist, will this mechanism have to be explored in relation to existing debt contracts? That would seem more complicated, just as well as restructuring these debts, or perhaps something to consider more going forward as new debt is issued going forward. So that would be my thoughts on Rodrigo's very, very interesting proposal. Now, on the BIT and bonds dilemma, that is something that I find also very, very interesting. And as Stratus mentioned, a lot of African countries have entered into BITs. And this is in particular because over the last 2 decades or so, African countries have made a big push for more FDI. And so BITs have played a very, very important role on the continent. Ghana alone has about 21 BITs signed, a few yet to be ratified, but a good number of them already in force. So it's a scary thought to think of bondholders potentially triggering these treaties on top of an already complex web of legal issues, including national law matters, as well as contractual clauses and all of that. So it's a real scary thought, and I'm particularly happy to note some of the recommendations he makes for being ready, as it were, inviting sovereigns to be ready by reviewing these existing treaties and understanding what scope it gives them to deal with any potential claims. So I find that very interesting. I think that he makes a good point about implications for future design of BITs, and I think that African sovereigns will be served very well by the advisors if they could explore that. On Mark's synthetic stabilization fund idea, I find that extremely helpful as well. Like I said, a number of countries in Africa have sovereign wealth funds, some of which have worked well and others not so well, but again, a lot of them are under stress now. What I find a bit doubtful is the international capital market access, or access to additional donor funds for this mechanism to work. That is something that needs to be explored in terms of how that would really work. But I do take the point that market funding may be explored for such a fund. This also brings to mind whether, at least one of the questions on my mind is whether this could be similar to the European Stability Mechanism, the ESM, which has been in place since 2012, with a lending capacity of some 500 billion euros. That is a fund that is set up to bail out distressed Eurozone member states. There were predecessors of this fund, but this one has been in place and it's funded a few of the Eurozone member countries, played a key role in managing the European banking crisis. The ESM is funded somewhat by paid up equity of member countries, as well as some market funding. And I wondered whether that could be a construct that could be explored in the medium term. But more importantly is the fact that the ESM works very well, well, some may argue not, but it works with the idea of a troika, the ECB, the European Commission, as well as the IMF, that underpins, the reforms that have to be undertaken, structural fiscal reforms that need to be taken by member states. In the context of Africa, I'm not sure how that would work. What types of mechanisms will be in place to support this fund for eligible countries. Also, who would be guaranteeing the debt that is, or the funding that is provided to eligible countries. I note from Mark's point that he's not anticipating a strict binding, if you will, time-based repayment obligation, but at some point the fund needs to be paid back. And it's important to, for me, discuss who would guarantee that eventually, so that it becomes a revolving fund. So these are a few of my thoughts as I've tried to think broadly about how these ideas might work for Africa. And by way of conclusion, I would make the general point that these 3 papers have all been excellent. The propositions are thought-provoking, and African sovereigns must definitely explore how these would work going forward. But as the governor made the point Governor made earlier, each country is really different. And so we have to look at what is really at stake. Is it structural? Is it cyclical? What is possible and what's not possible really going forward? For now, I just would stress the fact that African sovereigns are walking a very careful line, hoping that they are able to keep up with debt service obligations and retain the market access, which is extremely important to them, while still dealing with the economic fallout of the current pandemic. Existing tools would need to be used as a first step, if necessary, to avoid default. Understanding existing debt contracts and the tools that are available would be important, as well as looking to see what BITs that are in place might say concerning claims of bondholders. I think that the idea of perhaps a regional SPV, either similar to the proposed synthetic stabilization fund that Mark proposes, or the EU's ESM, could be explored as a matter of the medium term. But for now, I believe that more consultations may be required going forward, perhaps with the help of some regional bodies like the AFGB, the African Union, the UNECA, in close consultation with the IMF and the World Bank. Ultimately, African economies must really pursue policies that promote sustainable post-COVID recovery by instituting measures to boost not only revenue, but also, and by that tax and non-tax revenue, but also pursuing much needed fiscal consolidation in the short term to help return them back to fiscal and debt sustainability. Structural reforms are necessary because a lot of the debt-related problems in Africa are structural. And so we can't really work around that. And ultimately, we need to work towards more efficient sovereign balance sheet management as an answer to long-standing structural weaknesses. And maybe a few examples that may need to be explored would be sovereign wealth funds for countries that don't have it, but for those who have it, even better and stronger governance around it. Divestiture of state assets if needed, robust public-private partnerships to reduce debt and contingent liabilities, and then a very intentional effort to rebuild fiscal buffers and external reserves. There's really also the need to develop perhaps more efficient domestic bond markets so that we're able to attract more domestic savings without necessarily crowding out the private sector, and ultimately to create more of a balance between reliance on external debt markets as well as on domestic debt markets. So I really hope that I've been able to offer some views on how these ideas may work for Africa. And I look forward to more discussions when the Q&A starts. Thank you.
Thanks very much, Elsie. Wow, I think we've been given a real intellectual feast with these 4 papers with lots of questions. I think Elsie gave a great summary of the 3 papers and posed a whole lot of challenging questions to each panelist. And so I feel I need to give each of them a chance to respond to her questions, and also if they wish to raise other questions to other panelists. But before I do that, I just want to invite everyone to submit questions, and to remind you that to do that, you need to submit the questions in the chat room. Unfortunately, we can't call on people to present the questions themselves, so please put your questions in the chat room with your name and affiliation, and I'll be happy to read the question to whichever panelist you wish to address the question to. But first, let me, in the order that the papers were presented, give each person a chance to respond to the questions Elsie raised, as well as any other questions and issues they would like to raise. Rodrigo, let me start with you, and then we'll go around to everybody.
Thank you very much, Elsie. Thank you, Danny, for giving me the right to respond. I think that Elsie made very good comments, and I think that she just touched on the 2 most crucial aspects, which is pricing and how to incorporate them in the documents. Before I go to these two questions, which technically there were 5 questions, so these are the 2 which I find key or structural to the paper. I'm going to try to answer all of her questions, but let me start with her first statement or comment about this, which was a kind of more general and addressed to me and Mark about whether African problem is cyclical or structural, and basically I think that basically that there's a tendency to, and Elsie, apologies if I have interpreted you wrongly, but I think basically it's more about the latter. And I would say, as a general comment, I think that it really depends on the country. I will tend to be aligned with Elsie and the governor to think that it's more structural than cyclical, but or cyclical. I prefer to call it kind of more temporarily, but yes, I think it's more linked to the latter. I personally think that along the continent you will find instances of probably both. But I think that basically, in my view, this is one of the greatest challenges that DSSI is facing at the moment, because it's not necessarily solving a temporary problem, and that's why I think that there's a growing sentiment that we are dealing more of a structural issue than a temporary liquidity problem, and that's why I think that basically DSSI has found a little bit of how to put it mildly, some resistance or some difficulties in its implementation. Going to the other 4 questions that Elsie raised, I think that basically, let me start with probably the simplest one, which is basically for Elsie, it's simpler to digest a hurricane clause than a holiday just because, which is perfectly understandable, and that's why in my paper I try to link these with specific triggers and specific conditions. That's why I try to link these with predetermined shrinkage of GDP, and then in order to be able to, if that condition is met, in order to be able to trigger it, then debt to GDP ratio should be below X to make sure that it is a liquidity issue and not a solvency issue. Then we can discuss, and probably we can be here forever, about what is the debt to GDP acceptable threshold, and how do we know whether it is a balance of payment issue or a debt problem, and how do we trust the government in using these tools, and how do we prevent moral hazard. And that's why, for me, I think that I think that basically we can try to curtail this behavior through contractual limitations. I think it is possible, and that's why, needless to say, and I fully agree with Elsie, moral hazard is a big issue, and that's why we need to try to tackle this contractually ex ante, and that's why this is what I was referring in my presentation, that we need to make sure that there are specific corrections in place to prevent, and I put it between inverted commas, to prevent an abuse of the clause from the debtor side. And then I think that we need to move into the 2 more thorny issues, which is how do we ensure that this does not increase the premium, and how to incorporate this into bonds. Well, I think that the $1 million question is how do we make sure that this does not increase the premium? And we had the same debate when we were developing collective action clauses. When collective action clauses were going to be incorporated into that instruments, you say, okay, you're going to include a clause that will facilitate a restructuring. This might encourage unnecessary restructurings, and creditors will not be happy with a provision like that. The issue is that when the first bonds with CACs were issued, there was no increase in the pricing. So we go back to the the interest holiday provisions, and then we need to think what's the parallelism that we can draw with the analysis that was done back in the day about the inclusion of CACs. And the first thing that will come to my mind is, what is the cost of a default for the creditor? And I think that that disruption caused by a default, I think that surpasses any cost the creditors might see by including this type of clauses. I think that basically, from a creditor point of view, it's way more disruptive if there is a default, with the uncertainty that it entails, with the back and forth, with the negotiations, etc. The issue that we need to try to distinguish is, or the issue that we need to be aware and very careful, is distinguishing between those that default due to a true inability to pay and those that become slightly more opportunistic, because we have seen opportunistic defaults in the past. And also that I would say probably there's another third category that we need to keep in mind, which is those that have become serial defaulters. So I think that basically we need to foresee this, and of course I don't think that there's a one size fits all, but I think that this type of provisions, considering the cost of a default for both debtor and creditor, I think that they can be definitely a good addition to the sovereign debt restructuring toolkit. And going into the last comment or question, which is how do we incorporate these clauses in bonds? And again, I unfortunately, although I wish I have one, I don't have a magic wand that I can retrofit these provisions in all instruments. But as it took some time to include CACs in bonds, now most of bond issuances include CACs. Or now we have moved into a third generation CAC, and probably we will have to move into a fourth generation CAC, and we will not be able to amend debt retroactively. But at least this keeps on building in perfectioning debt contracts, and that's why perfecting debt contracts. That's why as part of the title of my presentation, this is kind of, I think that this is looking forward. This will not solve this crisis. This is something that we need to start considering for the next or the future crisis that will take place. I think that reopening the debt instruments just to include these provisions will not work, and that's not something that I envisage. That the problem here will be to find a first mover, but I think that from a theoretical point of view, I think that this could be a good provision to be added to the toolkit. The question is how we can make sure that this does not have an impact on the pricing, or if there's an impact that's kept to the absolute minimum. So I think that the issue is, and I'm using this conference kind of to as a sounding board, and the idea is now to move into kind of the second phase, which is doing a little bit more of the analysis and probably work with economists on a possible pricing of the clause.
Great. Strato.
Hi, sorry, I don't know if you can hear me. I'm unable to turn on my video for some reason. But I want to thank Elsie for those.
We can hear you though.
Okay, great. I want to thank Elsie for those insightful comments and for the feedback. just to follow up on a couple points. First, on her comment regarding the importance of treaty reform. I want to note, I want to emphasize a point, because I want to note these treaties can be invoked with respect to both domestic and external debt. Oh, I think I'm allowed to start my video now. Okay, great, I'm back. And so they can be invoked with respect to both domestic and external debt. Jurisdiction depends on the nationality of the bondholder, not on whether the debt is domestic or external or foreign. And so in theory, creditors could challenge not just the restructuring of external debt, but the restructuring of domestic debt. And even domestic nationals could incorporate abroad and place bonds that they purchase into a foreign corporation in order to get investment treaty protection. The reform of an investment treaty can't be overemphasized, the importance of it. I also want to note, just from quick observations, a lot of the treaties that African states have entered into, the ones that enforce anyway, a lot of them are intra-African treaties. And so there may be more of an opportunity to reform those treaties as some of the interests may be more aligned. And that's important because when you think about it, states, when entering into these treaties, face a similar coordination problem as creditors do in the restructuring of debt. States face this coordination problem when deciding whether to exclude sovereign debt from investment treaties or not. They may recognize that everybody's better off without treaty coverage of sovereign debt, but any one country it may be in the interest of any one country to be covered regardless of what other countries do. And so it's important that interests align, or that more coordination across countries be considered. Japan and Argentina came up with one solution to this coordination problem that was really innovative. In the new treaty they just negotiated, they excluded sovereign debt from the coverage, but they called for revisiting that exclusion in the event Argentina extends coverage of sovereign debt in any other investment treaty that it enters into. So there's solutions around this coordination problem, but certainly having states' interests aligned should make reform easier.
Great, thank you, Mark.
Yes. So, a couple of things. I think I have the same problem as Stratos had on video. It's the host that has blocked my video. Okay. As to the question of, well, the first comment that Elsie made was that the question whether debt is cyclical or structural. I tend to agree with Rodrigo, but I think that's, in a sense, irrelevant to the scheme, because we're not talking about whether debt is structural or cyclical, but whether the need for resources is structural or cyclical. And even if the debt is a structural problem, which in many cases I agree it is, it doesn't mean that the economy won't perform in a cyclical basis, and the need for funds and the ability to repay them will not be steady state, but will vary cyclically. And the references to ESM are interesting. I actually advised Greece when they did their restructuring in 2011 and 12. And of course, the funding came from the ESM. And I've subsequently worked for the ESM when they explored a number of ways in which to provide additional support for Greece going forward. The ESM is funded entirely in the market. They have guarantees from the member states, but no funding, no actual resources provided to member states. In effect, so the ESM has a AAA rating, and it borrows on the strength of the credit support of its member states. So in that sense, it is different from the Stabilization Fund that I envisage, because it can go into the market. It borrows on a basis of AAA rating supported by guarantees of the member states. On the other hand, the ESM has shown, because they can refund and they have very good asset liability management professionals, they have extended payment terms to Greece to an extraordinary degree, a degree that you will never see in the private sector, giving long interest holidays, long principal holidays, payment terms going out 40 years, deferral of amounts which bear interest and are going to, at some point in time, my personal prediction, have to be written off, because you keep deferring principal and interest for 30 years and have the deferred amounts accrue interest, you build up an enormous amount of debt. We've seen that in restructuring for African countries as well. But it's interesting what they've done, and I think it does support the notion that in order to provide assistance for countries, having something other than a fixed debt repayment schedule is important. Let me just make a couple of comments, if I may, with respect to Rodrigo's idea. In fact, this same idea in a more aggressive fashion has been proposed by a creditor. GMO, which is a fund that has been investing in emerging markets for many, many years, and with which I've worked always on the other side as an advisor to countries, starting with African countries many, many years ago. GMO put out a paper which suggests that countries should have the ability at any time, for no reason they would they would not have to give a reason, to suspend up to 2 interest payments. And what's interesting, so this is not something that necessarily is going to meet with wide resistance from creditors. This is a proposal from a creditor. What's interesting is they have also done an analysis as to what the cost would be if, assuming that the creditors, as I assume would be the case, would price in this option. As you would expect, that cost varies with the interest rate on the coupon on the bonds, because the amount being deferred, the higher the rate, the higher the amount, the greater the amount being deferred. Interestingly, they cover 2 circumstances. One, where there's simply a deferral and the amount deferred bear interest, and the other where there's actual forgiveness of the 2 interest payments. I'll give you an example of the cost. It's not enormous. In the case of a sovereign bond bearing interest at 4%, the increase in the interest rate would be 0.1%. And that's because the assumption is that the interest holiday would be taken at the beginning. Of course, if you said you can't take an interest holiday until later, maybe the first 5 years or something, then the cost would go down. A country that's issuing at 6%, the cost for the deferral would be 0.3%. So these are numbers put out by a bond fund, so they're not lowball numbers, I am sure. There are also numbers for forgiveness, which I can provide if anyone wants later on. But so it's interesting that this is an idea that, I think it's a good idea, and I think it's interesting that it's also being proposed by a large fund that specializes in investing in emerging markets. With respect to the comments on DSSI, I agree. There are lots of shortcomings in DSSI, and Anna has pointed out, and others have pointed out, that fully half of the relief would go to two countries, only one of which is in Africa, namely Angola. But the fact that it doesn't do everything we would like, or is less useful perhaps than some of its proponents think, is not, in my view, a reason to criticize it. Finally, Elsie's comment, with which I agree, is to the largest stumbling block to creating a synthetic stabilization fund is to try to get the official sector or bilateral creditors to come up with the credit enhancement. I agree, that is clearly the issue. But it's also the case, at least from my discussions, that the resistance that I encountered when I started talking to people about this in March is has been significantly attenuated based on more recent discussions. So it's not a piece of cake. It won't necessarily happen overnight. And I think part of the question has to do with internal accounting and how well this mechanism can be used to leverage the funds that are at, or the capital, if you will, of the institutions that are providing the support. Interestingly, when we had a discussion with the Inter-American Development Bank, they have very odd rules. They can make loans of $4 for every dollar of capital. But if they issue a guarantee, they can only issue $1 of guarantee against $1 of capital. So from their perspective, far from leveraging their capital, providing credit enhancement reduces by a factor of 4 the amount of assistance they can provide. That's unusual. And other institutions have different internal accounting rules. But I think to the extent that this can be seen as a way to leverage capital, it will be more attractive. Thank you.
Thanks, Mark. Elsie, do you want to respond to some of those responses?
Yes, Danny, thank you so much. I'd like to say thank you again to Rodrigo, Stratus, and Mark. Let me really stress that I find all their proposals extremely interesting and well thought out. And what I have tried to do is not to dismiss any of them, but just to raise a number of questions for us all to think around. And I believe that all three must be explored, all three must be looked into and discussed further. What I believe is that these may not offer help for the current debt situation in Africa. But perhaps, as some of them have rightly said, these necessarily must be looked at going forward in terms of how we design debt contracts, BITs, and the like. Let me just end by saying that I think Rodrigo's point about, which I made earlier, about how do we ensure that this, just because interest payment holiday clause does not necessarily increase the risk premium beyond what the fundamentals would account for, is an extremely important point that we really need to continue to explore. I like the fact that he gives the example of how CACs did not necessarily increase pricing beyond what one would have expected. But I think that these, for many creditors, may provide a little bit more of a headache than the hurricane clause. And also I like the fact that Mark says that some of the creditors he knows may not necessarily be opposed to this idea, but there are different types of creditors, and we need to sort of just work around what that would mean, and perhaps additional safeguards that would reduce this cost. I think perhaps that's what we should look at. The coordination problems that Stratus refers to is an extremely important one as well. And I do share the view that states must consider how to align their interest to ensure that BITs do not add an additional layer of complexity to future debt restructuring. And Mark, I think the issue of credit enhancement is really, really important. I think that for the African context, it will be extremely important, and it will be interesting to see how we come up with possible solutions. I think going back to the market for that may be difficult, but I believe that if one were to work towards a medium term, in the medium term at least, setting up sort of a structure along the lines you propose, and perhaps also learning from the example of the EU's ESM, we could get to a place where this prepares us for maybe future scenarios. And I think a regional structure like that for Africa is definitely something that we should work towards. In the context of regional cooperation, I think such a fund would be important to consider and to explore. And the details can be, of course, explored, worked out going forward. So I think I agree with all of them. Hopefully, we will all begin to work more on the details. The devil is in the details. And so I'll be happy to continue to discuss how we might be able to sharpen these ideas and, at least for the African context, help to make these a reality. Thank you.
Thank you. I think everyone's in too much agreement. We have 6 questions in about 15 minutes. So I think to do this, and I know it's been a long session, so I don't want it to go on longer than it will, but what I think I'll do is I'll put all the questions out there. Some of them are directed to specific people, and then we'll have a round of final comments and people can choose which questions to focus on or which comments they would like to make. And I'll begin with the specific questions first. First question for Mark from Fondos Galileo is, would you advise Venezuela to set up a sovereign stabilization fund, and how would you make it credible so that politicians do not have the ability to renege on it in the future? There's another question for Mark from Ted Truman, who says, the IMF once had a compensatory financing facility and also a buffer stock facility, but did away with them a decade or so ago. Could they or should they be revived in support of your proposal? There's a question for Rodrigo also from Ted Truman, who says, are there estimates of how much Grenada pays for the insurance of the hurricane clause? The other question for Rodrigo comes from, and please excuse me if I mispronounce your name, Chukwe Buka Ndukaku Emebina, who asks, what about a debt service to revenue as a better indicator rather than debt to GDP as an interest holiday clause indicator? And then there are 2 questions which are more general questions. One question is from, I'm just trying to find that question. From Zafania Achaba, the question is quite a long question, but it boils down to, do we need a sovereign debt law, something like a sovereign debt restructuring mechanism as a way to handle sovereign debt problems? And then Anna Gilpin has a question which says, creditor diversity seems to be a huge issue across all the interventions today. Exposures are also very concentrated, so that an initiative like BSSI goes disproportionately to 2 out of the 70+ eligible countries. How might we better promote coordination among diverse creditors? So let me start with Rodrigo, and we'll have a round of final comments. There's about 2-3 minutes for each person to speak. So Rodrigo.
Danny, thank you very much. I think that you cannot see me, but at least you can hear me. Okay, thank you very much for the questions and all comments. Mark, I'm definitely going to write to you in private to see if you have a copy of the paper that you referred to, as I have not had access to that. And I think that basically there are 2 specific questions and then the 2 general questions, the one by on the FDA sovereign debt restructuring mechanism or a sovereign debt insolvency law, and the one by Anna about creditor coordination. I think that these 2 kind of converge in one, because it's the same recurrent problem that we have been seeing in some of the crises, which has to do with creditor coordination. I personally do not think that we need a statutory approach to restructure sovereign debt. I personally think that it has been so far successful. I think that the private market has been able to overcome the difficulties. I think if you look at the degree of creditor participation in debt restructuring, it tends to be quite high. Can it be more efficient? Yes, it can be more efficient. The problem is that if we have a statutory approach, I think that that is a clear example of something that might definitely increase financing costs. And then it's the issue of credibility as to the reliability of the statutory approach. If you do want restructuring and then that fails, because the dynamics in the sovereign context are completely different to the corporate context, because you don't have the same incentives, you don't have the same sticks, like for example, appointing an administrator or liquidating the corporate entity. I'm not suggesting that that's the way forward for sovereigns, but what I'm stressing is the dynamics are completely different. Regarding Anna's comment on coordination, yes, definitely that's the main issue, and that's one which is recurrent, and that's one that we have been having difficulties for years or probably even decades. Mainly, we have three types of creditors: official, bilateral, and private sector. And then private sector also opens up in 2 or 3 groups. And on top of that, now with what has been happening lately with bilateral financing in Africa and Latin America, we are seeing new players, new entrants into the market, into the bilateral lending market, which pose an additional degree of uncertainty. Going back to the more specific questions, I think that basically this can be summarized in just one line, and Elsie put it very clearly: the devil is in the details. But again, I believe in the master craftsmanship of lawyers and how they can draft the detail of some of these clauses. So whether what are the sticks, the carrots, the incentives to prevent moral hazard, or whether debt service to revenue is a better indicator. These are things that can be tailored to, because also each specific debtor, I think, will be different. So I think these are issues that need to be tailored on a case-by-case basis. Danny, I think I have addressed all comments. Back to you, unless I have forgotten something, but otherwise, back to you. Thank you.
Thank you. The only one you didn't answer was the question of the price of the hurricane clauses in
Grenada. On that, we've been focusing particularly on Grenada. We need to, after Grenada, then there's a second sovereign that has also hurricane clauses or climate resilient bonds as well. So it's not just Grenada. Grenada, I put the focus on Grenada because that was the first mover. And going back to the issue of the cost experienced by Grenada, I tried to obtain a copy of those documents, but I have not succeeded yet. But as a researcher, I will not give up on that one.
Great, thank you. Stratos.
Hi, thank you. Just to jump in on the creditor diversity question from Anna Gilpin. I think this is really important from the perspective of international investment law when you consider its structure. So, you know, there are nearly 3,000 treaties. They're very similar, but really not always the same. As mentioned, they don't cover all investors. The coverage depends on nationality. There are ways around that, but even if all creditors could get access to treaty protections, the ad hoc nature of investment arbitration threatens to increase diversity of outcomes, right? So as tribunals can decide cases in diametrically opposing fashions if they're not bound by any appellate court or by decisions of other tribunals. So not only are some creditors covered and others not only are some creditors covered by different treaties than others, even creditors covered by the same treaty could be treated differently if they were to face different tribunals with different views to how international investment law applies to sovereign debt. And so this could make it harder for creditors to calculate the costs and benefits of holding out versus agreeing to restructuring. I'm not entirely sure how that shakes out, but it's not hard to imagine that some creditors miscalculate and hold out even if it wouldn't benefit them. And I think all this really just underlines how inappropriate the international investment law and the investor-state settlement dispute system is for handling sovereign debt crises. It's fragmented. And ad hoc nature, I think, make it even less appropriate than national courts for handling such crises. And so that's why it's important either to exclude it or to come up with some solution that addresses some of these deficiencies. Thanks.
Great, thank you. Mark.
Yes, sir. So on the first question of should Venezuela set up a stabilization fund, Venezuela's first problem is to try to produce oil. They've gone from 3 million barrels a day to about 200,000 barrels a day, and they're still, so right now that's maybe someday, yes, but right now they're a long way from having the capacity to do that. There's too many other things that need to be done. How do you require a country to honor its obligations under a national fund? I don't know that you can, frankly. You could make a default, I suppose, under debt, but that strikes me as a not terribly useful or efficient way to do things. But I think they're a long way from that. Ted, my good friend Ted Truman's question about the IMF compensatory financing facility and their buffer stock facility. Yeah, those are interesting things. And in fact, as I think I said, when we had some conversations with at least some people at the IMF about the synthetic fund, they were interested not just in the idea as a way to direct private sector funding, but also as a way for the IMF to, in fact, make resources available. So I think the idea, yeah, I think getting the official sector to use some of these techniques would be quite helpful. Anna's question, credit diversity is one I've spent a lot of time on. When we started to advise the creditors of Venezuela a few years ago, that was one of our first concerns. Of course, nothing can be done there because they don't have a government that can do anything or is interested in doing anything other than preserving power. But there you have a situation where two national creditors, Russia and China, Russia in particular, getting paid well ahead of everybody else. I mean, Venezuela stopped paying its private creditors in the end of 2017. So you have Russia and China who are getting paid. You have some commercial creditors who are bringing lawsuits like ConocoPhillips and managed to receive a fair amount of money. You have, litigation creditors. They're creditors of an arbitration award, judgment creditors or award creditors. You have commercial creditors and you have bondholders. There's a huge array. And one of the things the committee spent a lot of its time on was precisely how do we try to find a way that all creditors are treated in a comparable fashion. I won't say exactly equally, but comparably. And there are some ideas which we've thought about. I don't think we have time now to go through them, but I think it's a critical question. I think it's important to deal with it as the diversity increases, but I think there are, in fact, ways to do it. As to sovereign debt law, SDRM, there's clearly no political will to go down that path again after 2002, 2003. Would it work? I don't know. I'm skeptical, but I think our efforts are better expended in trying to deal with what we have in front of us. And I think there are things short of that that can be done. Thank you.
Thanks, Mark. Elsie.
Okay, I think my video is off. Okay, great. Thank you, Danny.
You're back.
Absolutely. So in closing, I just want to reiterate my earlier point about how it definitely is important that we, as Africa, continue to explore whether these mechanisms would be credible additions to the toolbox for managing debt going forward. But I'd like to come back to the issue of structural versus cyclical, or if you may call it more of a temporary liquidity crunch. Like I said at the beginning, long before the pandemic, we had a lot of African countries that were already stretched in terms of the fiscal position. So that really is a starting point. And then we've seen that the pandemic has just exacerbated things. But walking into a discussion with creditors, really, and the outcomes therefrom would very much depend on the starting point. The starting point being that a lot of African sovereigns lack the fiscal space and may be in a situation where, with a prolonged economic recovery from the pandemic, they may be in a very difficult situation. And the current DSSI talks remain unclear. We don't know where they would go. The IMF and the World Bank have provided a lot of liquidity to African markets, African sovereigns, but it's really not clear whether this would be enough going forward. So we need to get away from the situation where African sovereigns, like I said before, live in trepidation of even beginning to have credible discussions about what's in our toolbox and what might we be able to do with what we have, and what do we need to do more, in addition to what we have, to be able to manage what might be a potential debt crisis ahead. Unfortunately, there isn't a one-size-fits-all situation. Different sovereigns are in different circumstances, and each of them would have to figure out how they best deal with this. But these proposals that have been made by Rodrigo, Stratus, and Mark are worth thinking through and worth figuring out, if not for now, if not as solutions for the current predicament, at least for the future, for the near future, so that we're in a better place to deal with future issues. But I think ultimately we need to push for the structural reforms that are needed to put African countries back to a more sustainable fiscal and debt situation. So that will be it for me at this point. Extremely grateful for the opportunity to be able to discuss these issues, and I look forward to future discussions on these matters. Thank you.
Thank you. I want to thank all four of you for an extremely rich, stimulating, and thought-provoking discussion today. I don't know that we solved Africa's debt conundrum, but I think we certainly showed that there, with creativity, there's possibilities, and that there could be ways to at least mitigate the conundrum, if not actually solve it. So I want to thank you all very much for doing that. I want to thank the audience for participating and sticking with us, and for questions. This is being recorded, and so it will be available if you would like to look at it in more detail later. And I hope this has stimulated you to participate in some of the future panels that will take place in the DebtCon conference over the next 2 weeks. Before we sign off, Anna, I just want to check if there are any final words you want to say about future events or anything else.
Just cannot thank you enough. This couldn't have gone better, and it's so appropriate and so fabulous for Africa to kick this off. So Danny, thank you. Thanks to everyone. And tomorrow we go to Europe, and on Wednesday we go to Latin America. So stay tuned, don't miss the session. And if you have any problems with logons, just, spam all of us and we'll help. Not Danny, Africa's done. Thanks everyone.
Thanks. Thank you, everyone. It's been a wonderful event, and I really appreciate your efforts. And good night, everyone.